Well, welcome everybody to the Ellsworth Advisors monthly client update video. Today is July 10th, 2019, and we will be reviewing basically what's been happening through the month of June and year to date with our portfolios, give an economic update, and then also touch on a couple of topics that we think are timely at this point. I'm going to let Cam start off with a little bit of an economic update. Cam, what's been going on
Thank you, Kelly. Happy 4th of July to everybody. Hope everybody had a great holiday. Kelly, it is a mixed bag as usual. We had a really strong first quarter. First quarter GDP has now been finalized at 3.1%. Second quarter, the market looked like it was slowing. The economy looked like it was slowing. We had weaker than expected jobs numbers in April and May. And so that really opened the door for the Fed to possibly cut interest rates in July. Market got very excited about an interest rate cut. I mean, as you will remember, a year ago, we were talking about multiple interest rate increases.
Exactly.
Then all of a sudden, we saw a little bit of weakness. The president has been hammering on interest rates. And then it looked like July was going to be kind of a slam dunk that we'd have an interest rate decline. Last week, what happens? Record hiring. So jobs report was unbelievable. That kind of reinforced to everybody the economy is still strong. It looks like that interest rate decrease now might be off the table. So in July, I don't expect to see an interest rate decrease. I think the market now has taken that in, absorbed that. So I don't see a real big factor moving the market today unless we have some sort of incident. Is there an incident with Iran? Do we have some sort of resolution to the trade dispute with China? And then other than that, it's going to be earnings. I mean, I fully expect for the next 6 weeks, it's going to be earnings. And that's probably going to create a little bit of volatility or chop, as you say, until we wash through that. Are earnings going to be good? My expectation is that they're going to be solid. They're certainly coming down as the economy has slowed. Corporate profits are coming down, but we're not in a state of declining earnings. We're just at a state of slower earnings growth. And that's still, that's great. We're in a big economy that's still expanding. So don't see a big issue out there. Don't see any sort of cliff that would cause a major disruption of the markets, but do expect to see some volatility. And that's why we maintain, as we always talk about, quality.
Cam, I agree. Like you said, there's a lot of talk going in, the last couple of weeks that the Fed meetings this week would cause a lot of volatility, and a lot of it was going to be hinging on the Fed, a lot of Fed talk. Like you said, the strong jobs report last Friday was a lot better than anybody expected. Do we need a rate cut? Personally, I don't think so.
Agreed.
And, will we get some chop in earnings? Absolutely. Earnings, I think, are going to be all over the board. But, they're down from what they made. Their growth rates are slowing. This is, I think, from a comparison standpoint to last year, probably going to be a tough quarter. What I'm reading and seeing is third quarter earnings, a little easier comparisons. So expectation, like you said, next 6 weeks, we're going to have some volatility. We're going to have some opportunities. This morning the market opened, or the futures are showing the market was going to open lower. Get out of a meeting, and a half hour into the market open, it's up 170 points on the Dow. So, hey, it all comes down to individual companies. Earnings season, that's the key. That's going to tell us a lot about what's going on, how companies are basically setting expectations for future earnings, which, once again, the economy is solid. It's not growing at gangbusters pace, but then again, it's not shrinking. Mm-hmm. So if the rate slows down a little bit, not a bad thing. Basically, I don't think equities are super overvalued, especially in a low interest rate environment. That does have a factor. And, big picture, the market, if you go back 2 years, the market hasn't gone very far at all. Last year, once again, was a negative year. So far this year, things are up nice. And that kind of dovetails right into, where the markets are at. So in June, the Dow was up 7.19%. Previous month, the Dow was down 6.69. So basically, what was taken away in May was given back in June. Mm-hmm. So, year to date, we're back to up, year to date, actually through yesterday, we're up 16.36%, which, basically is where we were, going into May. The S&P in June was up 6.89%. Year to date up 19.97. So S&P year to date is a little stronger than the Dow, but once again, just June erased the losses of May. kind of back to where we started. On the international front, year to date, international stocks are up 14%. Emerging market stocks are up about 8.33%. Commodities up about 9%. So in general, things are up. Interest rates have come down. They came down really in May and a little bit more in June. So that helped bond prices a little bit. So in general, almost all asset classes are up. It's just to what degree. Interest rates, like I said, they pulled back with the concerns about weakness. Will they firm up a little bit? If the Fed doesn't raise rates, that's possible. But once again, interest rates are going to be held down by the global situation where internationally rates are so low that, hey, the U.S., they have the best rates. And for us to lower rates, it's hard for us to do because of the international dynamic where if we want, I'm sorry, for us to raise rates is difficult because if the rest of the world's interest rates are lower, money will naturally flow to the U.S., and if there's more demand for our bonds, that pushes interest rates down. So there's only so much the Fed can do. The Fed only controls the short-term rates, and if they push short-term rates up and longer-term rates are down, they could force an inversion of the yield curve, which has always preceded a recession. Is it a causation of a recession? That's a hotly debated topic, but I don't think the Fed wants to run the risk of inverting the yield curve and causing a recession. So
I think we're in that what they call the Goldilocks period right now. We've seen it before. Correct. Kind of every recession. Things are not too hot, they're not too cold, and certainly the Fed doesn't want to be the one to push this thing over a cliff. Right. So I see them standing pat throughout the year, let the market cycle play out, and they don't want to be the ones to trigger any sort of economic uncertainty. So as long as things are treading water and moving forward, I don't see the Fed making any steps.
Right. You're going to have. I think they're going to get a lot of pressure from the press and the president to lower rates. But if they can stay, not succumb to that pressure, lowering rates doesn't make sense. I do not believe that. And from a market perspective, like you said, you have to expect volatility, but I still think that the trend is up. From a portfolio standpoint, last month, growth with income portfolio, which is our balanced portfolio, it was up 4.76%. So, a little more than half what the Dow and S&P did. The reality is we only have 55% stock, so that's kind of performed in line. Year to date, it is up 12.6%. So, relative to its weightings, a little bit better than expected. Dividend yield, which is our dividend, our high dividend portfolio. That for the month was up 5.96%. These are a little bit more conservative stocks, so them lagging the market is not surprising. Year to date, about 16.4, so pretty solid there. A couple of our winners in there. Blackstone is up 17%. That's a holding we've had for a little while. And not all our clients are happy that we hold it because it is technically a partnership that produces K-1 statements, which can be a little bit of a pain come tax time. One of the drivers of Blackstone bumping up is they are turning into a corporation, which means after this year, no more K1s from Blackstone, and we can hold it. And holding on to it definitely made sense because we made decent money. Just last month, it was up 17%. So that news was accepted well by the markets. And once again, it's been a good, solid holding for us. LyondellBasell chemical company up there, up 17%. Eaton Corporation up 11. Caterpillar was up 13. UPS up 11. So those were the big performers in the dividend yield. Price potential up just under 7%, so kind of right between the Dow and the S&P from a performance standpoint. Year to date, the price potential portfolio is up about 18 and a quarter, so that's really doing what it should be doing. Big gainers in there. Motorola is up 11, Home Depot up 10, Estee Lauder up 14, Brown-Forman up 11, IQV up 18, so no huge gainers, but good gainers there. We only had one loser in there, and believe it or not, that was Google, down 2% for the month. A little surprising. And then our small cap portfolio. Small caps have lagged a little bit, obviously a little bit more volatile. For the month, up 5.85%. Year to date, still up 16 and a quarter, so pretty solid there. Here we have bigger movers. In general, the biggest loser is down 8%. That was New Age Beverage. So typically we have bigger losers in any given month in the price potential. Hydrogenics up 27%, Corvell up 17%, Vericide up 25%, Novacare up 19%. So, some bigger gainers there, but that's kind of natural in that small cap portfolio. So overall, portfolio is doing what we expect them to do. Once again, there's a little bit more focus towards quality of the balance sheets. And, so in a real strong up market driven by higher beta names, we generally are going to lag a little bit. But once again, what we did in May, our outperformance in May really said we're in the right spot. So I'm comfortable with where we're at going into, the next month. Once again, expect some volatility. And, the big key now is making sure clients have plenty of liquidity in their accounts for the short-term needs that they have, whether it's regular income distributions or bigger purchases. Other than that, I think we want to stick with what we're doing, at least through the next couple quarters, because I think there's more upside to come from the markets.
Well, I think an important point that you brought up is that our portfolios have bond exposure, fixed income exposure. We are sitting on some cash. Those are all tools. The cash obviously allows us to buy opportunistically as we do see pullbacks. The bond portion obviously creates some income, but also adds a little bit of conservative investment structure. So I think it's one of the things that we see a lot when we're out and we're talking to people is people want to talk about your returns. And as we've always talked about, we don't focus on our returns because we don't manage strictly to we're not 5 sets of mutual funds. We're different portfolios. And if someone says, well, how did you guys do against the S&P 500? Well, the S&P 500 is an all-stock portfolio. None of our clients are in an all-stock portfolio. So comparing absolute performance against the S&P 500 or any sort of index doesn't really tell the whole story. Now, that being said, as you talked about, your year-to-date numbers have been great. You've performed to or better than the market, and I think that, again, is the important feature is because we are actively managing these portfolios, we're making adjustments where we see opportunities. We're buying when good stocks pull back for noise or short-term issues, and yet we still have very conservative mixtures of stock, bonds, and cash. So I think from an asset protection standpoint, we're not out there swinging for the fences and trying to hit grand slam home runs. We're about quality companies, maintaining dry powder, having good exposure across industries, and really trying to put together very well-crafted portfolios that are going to be conservative but have that upside and just manage accordingly. I mean, manage for economic cycles and manage for the long-term outlook.
Absolutely. And the key is, are they doing what we expect them to do? The way the portfolio is designed, we use the benchmarks as, okay, based on how we're constructing the portfolio, in different environments, there are times when it should or shouldn't underperform or outperform a specific index. And if it's not doing what we thought it would do against that index, why did that happen? Mm-hmm. Well, maybe, hey, we just happened to, a stock really ran up and it outperformed better than expected, not a bad thing. Or vice versa, you get some surprises on the downside, and okay, that explains it. Then we address that one position and move on, whether it's selling it, sticking with it, or finding something else to replace it. Yeah, now we've addressed it, move on. So learn from our mistakes, or know where things went astray, adjust if needed, or hey, it just happens to be a short-term situation, or media noise, economic noise, or just an unforeseen circumstance. But that's the strategy. Something else I came across in the last couple of days, and this is kind of interesting. So I found an article, they're stamping back 10 years. So it's been 10 years ago. That'd be, spring of 2009. That's about the wrapping up of the financial crisis. The S&P hit its all-time low April of 2009. Not all-time low, but it hit cycle low of 666 on.
I had more hair and it was
March,
less gray. I mean, I
10
remember
years
that.
ago. So a little different environment where we're at in the economic cycle, kind of the beginning of the cycle. Now we're probably later in the cycle, maybe towards the end of it, who knows. But some interesting stats that popped up. So 10 years ago, the S&P was at 924. Today, today I think we crossed over 3,000. It's like, wow, okay, up over 200%. But the reality is in 2007, before the economic crisis, the S&P was at 1550. So over the last 10 years, well, prior to the economic, the Great Recession, the market's not even doubled or just barely doubled. So people say, the market's gotten way ahead of itself. You look longer term, returns really have been fairly mediocre the last 12, 13 years. Mm-hmm. Yeah, you go to the low point 10 years ago, yes, it's advanced, but bigger picture, you get out of that valley. Yeah, it's done well, but not fantastic. And you're looking at 7-8%
It's kind of what you expect from a
return.
mature economy.
Exactly. On the interest rate front, this is really interesting. So 10 years ago, the federal funds rate was at 0.25%.
Wow, 25 basis points.
Today we're at 2.5. So the government's been trying to do, or the Fed's been trying to get rates up to kind of normalize them. And once again, I think it's a dynamic of the rest of the world that's kept rates down. But the reality is rates are definitely higher now than what they were in the past, or 10 years ago. And even the 10-year Treasury note. So on the short end, what the Fed does, they've raised rates, but the 10-year 10 years ago was 3.8%. Now we're at 2.1%. Okay, a little bit of disconnect
Funds
there.
rate goes up, short-term borrowing
like I
goes
said,
down.
that's why I said I was reading through this. Is kind of interesting. The federal the budget deficit as a share of GDP 10 years ago was 9.8%. Now it's 3.7%.
That's amazing.
Okay, so a lot of talk about deficits and so forth, but the economy's growing.
Mm-hmm.
Even though the deficit number is bigger, the economy's huge. The percentage of share of GDP is actually smaller.
Now, that being said, I still would really like to see Washington get their spending problem under control.
Yes,
because this is going to be
a conversation for another day.
It is going to be a long-term issue.
That's way above our pay grades. Unemployment 10 years ago, 9.5%, pushing 10%. Now we're at, as of this print, 3.6%. And kind of a interesting fact around that, job openings, 10 years ago there were 2.5 million job openings. Today, when unemployment's that much lower, there's 7.5 million job openings.
That's amazing.
There's some cross currents going on. Minimum wage hasn't really moved. 10 years ago, $6.55 an hour. Now it's at $7.25. This kind of shows why there is a big concern about income disparity. The other interesting thing on wages, where did it go? 10 years ago, the real median household income 10 years ago was $60,000. Now it's $64,000. So 10 years ago, that's not even 10% inflation over 10 years. So that's less than 1% wage inflation over 10 years. That's a little bit of an issue. Median pay for CEOs of S&P 500 companies then was 7.9 million. Now it's 12 million. So 7.9 versus 12, 60,000 versus 64,000. Income disparity is a problem. I don't know if there's any answers for it, but you're going to hear a lot about that in the media with an upcoming election.
Well, and again, with that household income, I'd venture to say that a lot of that is, even though employment is low, a lot of people are working part-time jobs. And because, again, we've talked about the increase in productivity. There's a lot more robotics, automation, cloud computing, artificial intelligence going into the widgets that we produce, and we've just gotten a lot more productive. So, but that's a disconcerting fact right there between those two.
That's going to be a hot button for the election.
Yes,
you're going to hear that, and then the other, equality, gender equality, and so forth. In the last 10 years, we've definitely made advancement there. Percent of women on Fortune 500 company boards of directors. 10 years ago, 15%. Now we're up to 38%. So you're definitely seeing some movement from an equality standpoint also. Let's see, what else we have? Housing prices 10 years ago, 182,000. Now we're up to 276. So we've seen some recovery in housing, which is a good thing. Back to interest rates. Prime rate 10 years ago, 3.25. Today, 5.5. So we've gone through a long expansion. It's hard to characterize it as a super robust expansion. It feels like the market's gone up a lot, but over 10 years, really prior to the last crisis, we've had advancement in the market, but not gangbusters market. So a lot of times you'll hear the bears talk about the excesses of what's going on. I don't see a lot of excesses at this point.
This sure doesn't feel like 2007. It doesn't feel like 99.
That's exactly right. Through the 90s, you saw huge moves in the market, in the economy, a lot of excesses. We haven't got to the point, and typically you need to see those creep into the picture before you have a major rollover of the stock market or a major, recession or correction. Now, hey, we get a lot of good news, get some resolution with China, get some exuberance on the market. So today we just crossed over 3,000. The market runs up 10, 15, 20, 25 more percent. People will start plowing in. That could be the end of the party. But, on the track we're going now, I think we have some room to run, just have normal volatility. And like I said, I expect some strength into the end of the year.
Yeah. You know what? It's interesting with all these statistics tell me too a lot is how globally connected the world truly is now.
Absolutely.
I think a lot of our clients heard in the past there was always this phrase that when the U.S. sneezed, the world caught a cold because our economy was so big and drove so much of the global growth. That's still the case. We're still the largest economy in many more orders of magnitude in the world. But if you look at it now, for all these positive statistics in the U.S., for rates to have moved as far as they have, and yet borrowings are so low, vis-a-vis the Fed funds rate has gone up 900%, but yet short-term interest rates are so low, it really is because the rest of the world economy has not been as strong as the U.S., has been slowing down, and that has created a major drag effect on our overall economy. And as you said, money moves to the most efficient places possible. And so if we have the highest rates, capital flows in, that pushes rates down, and you just can't, you can't pull and push those levers. Eventually the market's going to dictate it, and that's why rates have remained so low despite significant inflows of dollars. So, we truly are in a flat kind of global economy.
Absolutely. And with the low rates, and that's one thing we haven't talked to clients a lot about lately. When rates came down after 08, 09, we've seen great mortgage rates and everything. They started creeping up a little bit last year. We're kind of in a window now where mortgage rates have come down again, and I just want to throw this out there. If you haven't looked at the rate on your mortgage or any major debt you have, now's definitely a good time to revisit that.
Great time to refi.
I'd be more than happy to talk to you about it because refi may make sense to lock into potentially sub 4% rates. On a mortgage is a good thing, even if you're in the
mortgage,
fours.
Even consolidation.
Let's look at those things. That's something that who knows how long this window is going to be open for kind of a second shot at these sub 4 rates. Now's the time to look at it.
Absolutely.
Feel free to reach out to us and let's discuss it, see if it makes sense. Other than that, have a great June or dog days of summer, July. That's all we have to say this month, and we'll be talking to you again in a couple weeks.
Thanks, everyone.
Thank you.